Welcome to the MHP Exchange Podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
And we're back on another episode of the MHP Exchange Podcast. I'm your host, Frank Rizzo. Joining me is my partner, Eric Busadil. How are you today, Eric?
Good morning, Frank.
So this is, for those of you who are watching the video, this is opposite day, right? It always seems when I do one thing, Eric does the opposite. So typically I have my shirt tucked in, Eric has his shirt out. Today, Eric has his shirt tucked in, and I came in with my shirt out. So obviously we just continue the tradition of doing everything the opposite of each other. We have a very special program today, and for guys and people out there who are listening who are interested in how to put together a deal, how to deconstruct it, we have a guest, Dane McKinney from the Stack Asset Group, and he's also one of the co-hosts of Deal Junkies, which happens to be one of the podcasts that I will religiously listen to whenever I'm traveling, whenever I'm in the car. I'm a huge fan on how they put together deals. I want to give a very warm welcome to Dane McKinney. Dane, how are you today?
I'm doing well. Yeah, thanks, Frank. I didn't know you were actually a listener. We have a bunch of people email us and say, like, we'd love to be on the podcast. We listen to Deal Junkies all the time, but I'm pretty sure it's just VAs. So I'm surprised to hear that. That makes me happy.
So, Dane, I mean, Eric and I, we travel a lot to our communities. So we're based in New York. All our assets are out of state. We're down in, Georgia, Alabama, North Carolina. And so when we used to drive all the way to Alabama, which was a 17-hour trip. We stopped that. But when we take our 8-hour drive down to North Carolina, sometimes I find myself in the car alone. I will put your guys' episodes on, and I'll listen to 8 hours of how you guys are deconstructing deals and putting things together. And that's why I was like, wow, we really got to get Dane on the program. So I appreciate you being here today.
Yeah, that's awesome. I appreciate that. You kind of inspired us to be able to do the podcast virtually too. So we'd love to reciprocate once we get that set up and have you on. It'd be awesome.
Perfect. Love to hear that. So for those of you that aren't familiar with Deal Junkies, Dane's based. Your operations is based in Oregon, correct?
Mm-hmm. Mm-hmm.
And he's a syndicator. He's got over 80 multifamily units under his belt right now, and he's constantly doing deals. And one of the things that you really specialize in, Dane, is creative financing and deal structure. So, obviously you're a young guy that you are. Like, how did you get into this space so early, and what really kind of accelerated your growth in looking at things so creatively?
Yeah. Part of it was happenstance and kind of just fortune on who I met. And then part of it was intention, in that I got into real estate because I had known a number of men in college one woman in college who had made just a fortune off of real estate. And so it got me interested in getting into the game. And then I was in property management. That wasn't going to be my shtick. Found that out pretty quickly. And so I got licensed, and I thought that everybody who was like a commercial real estate broker just wanted to own deals. That is not the case. It is mind-blowing to me still how few brokers want to own deals. It almost seems backwards, because the argument is always that you're if you are trying to buy the deals, then you're competing with your clients. And I think that logic is just wrong. It's really, really hard for me to sell something that I wouldn't also buy myself. So that's kind of, I struggled at doing anything in like the office or industrial space, because I wasn't super interested in buying it. And so I switched over quickly to multifamily. And then the creative structuring just came from the fact that I had no money. So that was me hearing from my boss that there was no way I could, start buying real estate for the next, 10 years, I had to start brokering deals first, really create a foothold for myself in the community, start talking to a bunch of owners and really broker and start understanding how multifamily worked better, I guess, so that I could buy deals. And he said that to me in May. And then I switched brokerages because I sat down with a guy who told me I could buy deals without any money in July. And then I bought my first deal in December, and that was all in 2021. So, and I bought that with a 96% seller carry. And so it was really just necessity, right? You find what you're looking for. And so I talked to both those partners about how they structured all their deals. And they just said, we never use any of our own money. We always buy like heavy value add stuff, and then we put our own money in on the back end, right? So you're using pre-tax money to do the CapEx and improve the properties, but you're not using post-tax money for the down payment on the property. And sellers really get that. They're investors. A lot of them are in it for obviously just to own good assets, but then a lot of it is just people who got into it for the tax side of things. And so explaining that side of it has been a kind of a big piece, I guess, but there's just a bunch of facets to the negotiation that get sellers interested in carrying a note for us.
And for those of you that listen, Dane talks a lot about getting the seller to be an equity participant, right? Like,
yeah,
which is unusual, right? And so for those that are listening here that aren't familiar with that, you want to explain that strategy, because you talk about getting the seller to be a participant, not on just the debt side, but an equity participant. So they're vested in the success of the outcome.
Yeah. No, that is probably the most common strategy we use. So we have projects right now that we're doing that on, that we're going to buy. We have 2 that we're about to go under contract on, and then 1 that we're under contract on. The strategy is essentially it's figuring out exactly what the seller's goals are and getting them to trust that you can help them achieve those. And so we find a lot of brokers who tell us that sellers will never do a certain thing with their money, in terms of, no, they would never go into second position, or they would never go off title even. And we know it's not true because we have a number of those loans. And so then it's just a matter of getting in front of the seller and saying, hey, here's our track record. This is what we want to do with you. And so as an example, like a deal that we bought probably a year ago was $2 million. Seller carries $1 million, and then the bank gives us a loan for $1.2 million. The seller carries it, and so they aren't paying taxes on it, but they're not carrying it in the typical sense, like IRC 404, which is the seller carryback code that just says if you receive the funds back, you have to pay taxes on it. If you don't receive and recognize the funds, then you don't have to pay taxes on it yet. And so it stays in escrow, and then it goes back as a note towards us. We go to improve the property with the funds that the seller gave us, and then we just have a promissory note with them, right? And so that's all the IRC code says, is that you have to have the promissory note. It never says that it has to be secured in first position. The government doesn't care about your security on the money that you lend out. The government just cares about the fact that you have no access to it. And so getting that across to sellers and just saying, hey, we've got $150 million in notes. We've never defaulted on a note. We're actually not going to start with this $1 million note. This isn't going to be the first one that we default on, right? We've got a really good track record. Here's a bunch of the past projects we've completed. And a huge part for me was being able to leverage my partner's success. And now I'm kind of at the point where I can show projects that I personally have helped improve. But, for somebody getting into it, finding a partner who you can use their track record and their kind of bank statements or PFS or SREO, which is just like how much real estate they own, right? And then you can go find the deal and structure the deal. You can, create a huge amount of value and then end up getting to own part of it because of that. And that was the no money downside of it for me, right? Was I had to figure out which piece of the puzzle I could put together in order to own it.
So interesting to me, Dean, is that because you mentioned that, brokers don't want to believe that the seller would potentially be interested in that. But, just looking at our history and the sellers that we've dealt with, and then the, bunch of deals that we've worked on, you have so many sellers that were so passionate about their properties, but just didn't have the means to like get it to where they want it to be, right? So, that's, when you say like brokers don't realize that, I would say the exact opposite. Like most sellers, I mean, unless you have, a really older person who just wants to go, but, for us, we buy deep value add properties, right? And the property owner before didn't have the capital, didn't have the team, or they started out and they just couldn't get it there. But if you could develop that, trust and relationship and, keep them involved, I mean, I could almost say that most sellers would be open-minded to at least listening to what you're doing. I mean, I couldn't agree with you more on that.
No question.
Yeah, and I think it goes down to that, most brokers or agents, they're not the creative deal that gets beyond them, right? It's not in their thought process. And I hate to say it because I come from the brokerage world, but they're looking at closing the transaction, right? They're very transaction oriented. So it's like, I close the deal, I get my check, you're talking to me about something that's causing me brain damage, right? Now I have to, where am I making my money in this? Am I going to have to hold back my fee? And I think that negates, and they don't look at it the way you said you look at it. They don't look at it from an owner's mentality. They look at it from a salesperson's mentality of, let me get my fee and move on. And you're actually, making me jump to a couple additional hoops, right? Do you find that being a challenge?
No question. Yeah, that is actually it's funny because the argument on the front end is what I said, which is like, no seller would ever do that. I would never tell a seller to go into second position or go into an unsecured promissory note. And it's like, well, hey, would you rather have a secured promissory note to a project that's over levered to some like high school kid? Or would you rather have an unsecured promissory note to a guy who has $200 million in assets, has never defaulted on a loan, has perfect credit, makes, a couple $1,000,000 a year, who has 3 other partners who are in construction and who are going to do the project themselves, operate and manage it themselves? It's like, who do you want to give I think you get this, brokers get this idea of security it's false, right? And in 2008, there were a ton of banks that weren't super happy to be in first position on a ton of notes. Right.
Sure.
And part of that was because this idea of first position meant that you had all of the security in the world when it doesn't, right? It's asset based. And so I think that's why we've had a ton of success, is getting people to understand the personal side of it. And people like that, but brokers don't want to do that. Brokers are on the transactional side of it. Brokers want to get paid.
And it's probably, I mean, give me a scenario. You have to, obviously, I would imagine, get the broker to allow you to have this conversation with the seller usually, right? That's another obstacle typically where, brokers are very protective of that, right? So only you are going to be able to relay everything that you just said to a seller. The broker's probably not going to be able to do that.
I just real quick on that. I do think that is almost an advantage of us being brokers as well, is because we can kind of speak to I'm a broker, but I really don't try to broker deals. I broker our own deals when the time comes. If something's on the market, then I'll broker it because there's no sense in not. It's just easier. But if a broker brings us an off market deal, I don't get paid. I don't want to get paid. I'm an investor, right? And brokering is, a day job, and I can make money from it, which is awesome. But at the end of the day, my goal is to invest. So yeah, getting the brokers to let us talk to the sellers is almost easier though, because we have a license. And so I'm saying, like, I'm not going to put my license at risk by doing anything that I shouldn't do. You're still going to get paid on this. I'm never going to go around you. And then we also just have a track record of not doing that, right? And so a lot of the same brokers work with us over and over again and are constantly bringing us deals because they enjoy the experience. Because we end up just brokering the whole thing anyways and talking direct to the seller, and then they get paid the full fee. And it's like, what a dream, right? Like you have a buyer who's writing all the paperwork, doing all the work, talking to the seller for you, and knows how to build that rapport with the seller so that they're happy about the transaction. And then you just get the full fee. You do none of the work and get all the money.
And listen, they did their job. They brought in a ready, willing, and able buyer, and they presented options. And in the way you're describing it and how you're, executing on the equity participation, it's almost as if you're doing a 1031, but instead of doing a 1031, where you're buying another property, and if you don't want to operate, own, and manage the property, hey, you already know the asset. You're comfortable here. You know the asset. There's no better place for you to put your money, and now you can get a higher yield on it because that equity is just sitting there, but you're going to get an A+ team behind it, right? Because I'm sure in a lot of cases they're not just investing in the asset itself. They're really investing in the operation and you and your team. I think you're muted. Yeah.
You're on mute.
I think I unmuted. Yeah.
You're back.
Are we good now? Okay.
Let's just.
Yeah. No, I
was kidding.
I couldn't hear you. I'm trying to make sure. There we go. No, you're absolutely on it with the higher yield for the seller. And the other side of it is they already know the asset. So that it's the easiest 1031 exchange ever because they don't have to find a new asset and try to fall in love with it. And to Eric's point from earlier, it's like they really want to see the property improved a lot of the times, and they just don't have the money. And so we come in with 4 guys who do have the money, do have the knowledge, do have the expertise. We have an in-house construction company, and then we have an in-house property management company, and in-house asset management. And the seller's just like, it can finally happen. Right. And so I get to see the upside on it. I also get to see what I wanted to do happen. And we've gotten lower prices we've gotten under contract at a substantially lower price than what they had other offers for because they trusted the team.
Sure.
And they wanted to see the outcome of it. And they could hear the story behind it, I guess, for lack of a better term.
And it always goes down, and we talk about it a lot. This is, real estate. It is an operator's business. It's never just about the bricks and sticks. It's always about the people and the people behind that deal, right? Now I know you focus, right, primarily in multifamily, but you are in other asset classes, right? And we find that interesting. We got into the mobile home park investing space, and before that, I'm a broker. Eric's in finance and commercial lending. And we were in other asset classes. So we got into this space and we just narrowed our focus right into this asset class, and that's it. But you touch a couple of different asset classes. Like, do you have the same buy box for each? Do you have different parameters for each asset class that you look at? Like, how do you bifurcate the asset class purchase?
Yeah, we try to stick strictly to multifamily. Doesn't always work, and part of that is because we are so much more finance oriented than we are asset oriented, if that makes any sense. And so all of our group members happen to just own other stuff prior to becoming part of the same team, I guess. And so we were all comfortable with looking at different things that we would just call a deal, right? And so if we can figure out a way where we can go in and create a ton of value in a property, no matter what it is, a lot of time it's just on a basis perspective. And so what's the price per square foot that we're getting in at, and then what can we exit at, as opposed to like a cap rate perspective, if that makes sense. And so especially on assets that, what's a good example? We bought a 2.4 cap this year, right? Nobody buys 2.4 caps, right? But the basis on it was so incredibly low that we knew if we drowned for 6 to 12 months, that a year later we would over double our money, right? And so I think that people get stuck on the cap rate perspective, and we kind of just look at it from a number of different perspectives. Usually from the construction lens, though. because that's where we can create the most value is in improved operations and construction. And so if we know a market really well, then we're happy to go into other asset classes. I wouldn't go into another asset class in like Georgia though, or I wouldn't go into another asset class in, the Midwest, just because I don't know that asset class as well as I know multifamily. And so if I'm in my own market, then I'm comfortable in different assets is I guess the best way to put it. And then also if we can get a deal that's no money down, then usually it's worth our time and our minds to kind of figure out what's going on with that asset class. And so we'll spread out because we're less like multifamily investors and more just creative investors, because we all have the finance background. So that kind of connects us all, even though we have different skills in real estate. We all came from some sort of finance background. So
that's an interesting point, because I think cap rate is great if you're buying a stabilized asset and you're just looking to park money with minimal brain damage to operate the asset. But for us, we're value add investors. I mean, the cap rate to us is almost inconsequential. Like, we want to see what our yield on cost is going to be going into year 2, right? If we know we're going to buy at this basis, this is the investment that we need to make in our first round of capital improvements while we are kind of normalizing the property and the income stream, where's that yield on cost going to be, right? And if we're happy with that return, then we know over time that asset's going to perform even better for us. And some of our best deals, the income would be negligible day one, but if you want to find a great opportunity, sometimes you've got to be willing to do the work and take that risk, right? And buy that asset that nobody else wants to make it work.
Totally. What yield on cost are you guys targeting?
So we target it's got to be within 24 months. It's got to be 10% or better, right? So if it's over 10% based on the capital that we're going to deploy and the work that's going to where it's going to be, not at stabilized, but where we feel like we've normalized. So typically, when we're buying a mobile home park, we understand that if you're buying a legacy property, third generation, and maybe hasn't had any improvements in a decade, last time you've had a lot rent increase has been 10 years, and it's been mismanaged. Once you go in and start doing the things that we like to do, instilling a certain culture of responsibility for the tenants and for us, start making improvements to the land and making improvements to the infrastructure, and start moving rents closer to market, we're going to see some turnover, right? Yeah. You're going to have people who don't want to conform, and then we're going to be leasing up at the same time. So there's going to be, a dip in income initially, and it's going to take a little while in that market for the market at large to realize that, hey, there's changes that have been taking place. Maybe I should go revisit this park, and the income will start to scale up from there. So we found historically it's about 24 months to get that period, of normalization, and then once you get at that point, then new people are coming in at market rates, and the deal really starts to accelerate from there. I mean, that's been our experience in the decade of doing this.
How long do you guys hold the deals past that? Does it vary deal by deal, or?
So that's a great question. So when we started, we were syndicating our deals, right? And so when you're syndicating the deals, we had, we executed at a business plan, and we had our underwriting. And what we found is early on in our deals, based on what happened between 21 and 23, right? We hit our 5 or 6 year plan in 3 years. And so then as a fiduciary, we were probably net sellers during that time, and we kind of shuffled the deck. And now we've created a platform that gives us a longer lifespan life cycle with the assets that we buy now. So our whole period, we always look to like a 7 to 10 year period of where we can kind of maximize the asset and get the higher, multiple on it. But that's where we're looking at some of our assets now, kind of 7 to 10 years.
So you said you switched platforms. What did you mean by that?
I mean, we started syndicating. We launched the fund, right?
Yeah.
So
Oh,
the fund has a longer life cycle. So rather going from one deal syndication to the next, we found that when you had everybody was most of our investors were like, why are you giving me back money? I just
mhm.
but to do a 1031 inside the syndication is very complex.
Hard.
So we basically said, we'll return the capital, and then they'd invest in the next deal, which created a taxable event for our
Yeah.
partner. So we wanted to, if you like the platform, like what we're doing, hey, we have a fund where now you can participate longer, and we can enjoy some of the tax benefits, over the duration of the fund.
Wow, that's awesome. So is it open ended then?
It's closed ended.
Okay.
We're rounding out. We're closing out the first fund in the next couple of months. Right. We have one deal. This one deal that we're closing out now. We'll close out the fund now,
Hmm.
and we'll see how things move from that point forward. Whether we do another fund or we go, or we syndicate or JV a deal going forward.
Yeah. Did you like the fund model more than the syndication model, or did your investors like it more?
I think it has pros and cons. I think I don't want to say most, but a lot of investors like the fact that they know, hey, this is the specific deal, right?
Mhm.
And then you have those investors that like that, but they don't like giving back the money, getting the money back.
Mhm.
So it's a mixed bag of nuts, right? I think,
Yeah.
and then when you have one specific property, there's that urgency, right, to close the deal. Hey, we have property, we need this amount of money to close this deal. When you have investors that are used to, syndicating, right, deal by deal, and now they've done that with you for so long, and now you're switching model. That's another whole conversation where, all right, well, let us know when you have the next property, but that's not how a fund works. So I think
Yeah.
there's mixed reviews on that.
Yeah. So and look, it's like anything else. There's pros and cons on it. I mean, the benefit is you get the tax benefit. You're going to have a longer term duration. If you're looking at your equity multiple over time, it'll far outpace it because you'll be able to grow. You'll be able to grow that base. Um, as long as we're able to continue to execute the way we've been able to execute. So I think that's one of and you're able to mitigate your risk along a broad stroke of assets rather than just being involved in one deal. So there's benefits to it, but it's like anything else. Like I think it's got to be part of the portfolio you're building inside of real estate. If you're going to be a passive investor in real estate, you've got to have that type of exposure to different investments to get the type of income you're looking to generate over time.
Yeah.
And you're syndicating your deals, correct?
I would think of it still as just that we're focused on funding the deals with other people's money, which sounds like bad at some point, especially when you're doing a syndication. And we'll have our GP will have like $500,000 into the most recent syndication that we're working on. So by no means are we getting in no money down. But syndication is just really a tool in our mind. And so for deals where we can't get seller participation, but we really, really like the deal, syndication makes sense for us. And so our returns on syndication are substantially better than a lot of the deals that we're doing personally. But part of the reason, I mean, when we do a deal personally, we know we're going to hold it in perpetuity. We know we own 100% of the asset, and we don't really have anybody else's money to answer to because everything's structured on the front end, right? With the seller's equity note or equity note, and then the debt from wherever we get the debt from. So we kind of know we have this 10-year runway when we're doing a deal like that versus with syndication. We, a lot of times it's a 3 to 5 to 7 year hold. And it really, again, we're fiduciaries. And so it depends on, it depends on what we think the best scenario will be for the investor and not necessarily, for us, right? Not at all for us. Even though our preference would always be hold it in perpetuity. I think that's why we have worked so well together. And kind of our part of our disdain towards syndication is just we're not 3-year holders. I mean, that's not our model, I guess. But when the deal makes sense and we can all kind of make it make sense from an effort perspective on our end in terms of just taking fees, which we're really not fee people either, but just knowing that we can create a really, really good asset and knowing that we can operate it well in a market that we understand really well, it's hard to not want to do those deals. So we are doing our first actual 506C.
Okay.
Yeah, I believe. Is that or maybe it's Reg D. It's for accredited investors. And we're allowed to advertise it. We got all the docs done actually by an attorney from New York. So yeah, who we connected with at Raise Fest.
Excellent. So when and you've talked about a little bit about the operation. I know you're on the deal side. Are you basically scouting, finding the deals, underwriting? Is that your role? Are you on the operation side as well?
Yeah. Yeah, I am. So I am mostly finding the deals and negotiating the deals, kind of setting up meetings with our larger partner, with the sellers, because he's the credibility. He creates a ton of believability. He's super easy to trust for a good reason because he has a track record that's worthy of trust, right? And so my role is in part to find the deal, in part to do like the initial underwrite, and then I pitch the deal to the rest of our group. So I say, hey, here's the key metrics, right? I think in 2 years we can hit a 10% yield on cost, or I think in 2 years we can hit our internal metric, which is a 30% project level IRR. And so 20% to the investors. On the most recent, we're at like we're at 19.1% IRR to the investors over a 32-month-old projected. So that's our internal metrics. I go pitch it to the group. They say yay or nay, and kind of we all give our reasons why, and we argue about it. That was something we actually got from the one thing from Blackstone, was that they early on they had to get a group consensus, and they couldn't even they had to get every person in the room to say yes, we like this deal. And if one person said no, then it was everybody else's job to say, well, hey, we need you to say okay. It can't be no. We have to get you to say okay. And so we've kind of gotten to that point where we have 4 people, everybody has to say yes, or everybody has to say okay. And we've had deals where one person said no, and then the rest of us couldn't get past the thing that they couldn't get past, or at least argue against it. And so then we ended up having to just drop the deals, and we're fine with that. I mean, I think we're better off in the end for it. But on the operations side, which I didn't answer at all because I got excited about the other piece. Yeah, I help on the operations side. I help on the asset management side because I think that a key part to good asset management is like proactivity instead of reactivity, which is something that took us a while to learn on our own projects. And now that we've learned it on our own projects, feel comfortable implementing it on projects that are, where we're raising money from investors. But just to say that we're looking at the project ahead of time and saying, hey, this is going to be faulty. We need these units to be dropped now, not 3 months from now, so that we're not missing, rent on, especially on a new construction, right? Project where you've got 66 units that all of a sudden you need to fill today, right? And so just saying where we need to put the rents at, the things that we need to fix, like property level, that are just don't look good, right? And are going to affect whether or not somebody wants to rent a unit. I mean, we just need to power wash one of our properties right now. And like, I think that's a huge part of the curb appeal. And we need to figure out, we need to do that 3 months ahead of time so that we're not losing that income for 3 months while people are touring this place. And they're like, why would I live here? Why would I want to live in this place? And so it's more making sure that the project or the property manager is on the same page as the asset manager, which is us, and saying, hey, here's our business plan. Here's what we want the outcome to be. Here's why. And then making sure that they understand that. It's really just like creating a vision for the property manager more than anything. And No, you can go. Sorry, Eric.
It's super important. I mean, the property manager needs to understand the financial aspect of it, right? And,
Yeah.
I don't know where you find your property managers, but, we've taken on existing property managers most of the time and done really well with it, but most of the time they weren't at all involved with the financial aspect of it, right? They were just more involved in the aspect of making sure they're doing repairs and the collections, but they weren't truly understanding of, what's coming in, what's coming out. And in order for you to be successful, they have to understand all of the financial aspect of it. So you have to be involved with it.
And to be clear, Dane, like when we talk about that, each community we would buy in a mobile home park, they would have like an on-site property manager. So we don't go third party, we do everything self-managed. And what Eric's talking about, property managers typically from the legacy owner wasn't showing them books of records, wasn't opening up, lifting up the skirt a little bit to say, hey, this is what we're doing, this is where we need to be, and this is why it's important. And you guys you act more as an asset manager than say the property manager, but you're giving your property manager some real important, milestones, like this is where you need to get because this is where we're looking to go, correct?
Yeah, totally. And frankly, all our partners are pretty good at it. Our largest partner owns a property management company that manages 7,000 rentals in Oregon, and so he obviously has some pretty good experience with asset management and property management. And then as far as like on a daily basis, the other three of us, which is Trevor, Mark, and I, we're also just pretty hands-on, frankly, just because we're not syndicators, we're investors, right? And so that's kind of the biggest distinction is like we want to own the assets and we want the assets to perform to the expectation of all of our other assets. And so that's kind of I take a role in operations, but so do the other guys. We all kind of just do, and we have weekly meetings where we discuss what's going right and wrong, and why, right? Because we all have the same expectation for performance.
So we've covered a lot of ground here. So I want to step back because we get contacted from people from this podcast, right? When they're starting out, and the biggest issue is when they start out, it takes so long for them to find their first deal, right? Because they don't have a partner, right? And they're coming in themselves and they're competing. But you have a process in here, right? A couple of things that I've taken from this. When you go in, you're finding the opportunity. Are you negotiating first before you're doing your own internal underwriting, saying, all right, I know this deal kind of works. Here's the number the seller wants. All right, let me negotiate a price and terms and then back in my underwriting, or are you doing your underwriting first because you really bought your first deal pretty quickly when you decided to? Like, how did you make that pivot, right? So people who are listening, they'll say, I've got to accelerate my growth. How do I execute that? What would you suggest?
Well, I think that was kind of a two-parter. To the first part, in terms of the order of operations on a deal, in our markets, in the markets that we are active in, I guess, in Oregon, which is kind of the Willamette Valley, the North Coast, which is on the Columbia River, and then the Pacific Ocean. We have a bunch of projects up there, and then some in parts of Portland, but we're more just active in the valley. On those projects, very, very quickly, I can tell you what we have to hit in terms of price, or what we have to hit in terms of interest rate and timeline on the note from the seller. And so I'll say, hey, if we can hit this price and you'll give us a 10-year note at 3%, it will work. And we're going to start there. I got a price anchor there. And then, sometimes it ends up being 7 years at 6%. Sometimes it ends up being 5 years at 5%. But we kind of just price anchor. And so it's super, if they'll start the conversation of, I would carry a note for, I could probably do seven, maybe with an extension to 10 years. Then we're really going to sit down and underwrite a project and say, okay, this can work at these numbers, and it's going to be kind of tight for us, and we're fine paying max price for any property if we can get our terms right. So that's kind of that's the order of operations, I guess. Is I'll just say to a broker, especially a broker who knows us already, I'll say like, hey, have you had the conversation yet of like 40% carry, 10 years 3%, and then they'll say no, or yes, but here's what they said, here was their reaction, and then it's like, okay, well, ask them this now, or like say hey, and then once we have a real conversation, or I know that we're going to have a phone call with them, then I'll really sit down and underwrite it, so that when I go in, I know where we can give and I know where we can't give, because it just varies on different properties. And part of the reason we need a timeline in Oregon is because we can't raise rents more than 10% per year.
Got it.
And so we have a rent control regulation, which means that if market rents are 1,500 and the rents that the seller has are at 700, we can never hit the market.
Wow.
We can't ever get there.
Yeah. So
it would take us a decade to get there.
Sure. So Oregon and New York, very similar, right? Like New York, you own over 10 units, you're rent controlled on all your units. So you can own 12 units throughout the state, and all your units are rent controlled, which puts you in rent control guidelines in terms of. And there was a recent case in New York, right, Queens, that essentially said, the judge said that just because a tenant is not paying rent doesn't mean you don't have to offer them a lease. Rent is not precursor to you offering them a lease, right? So I see Dane's face, and it's like, just for those of you listening, not looking, his eyes are all scrunched, and he cannot. But New York, Oregon, this is what happens when you operate on the coast, right? You get these weird policies, and that's why we tend to operate in places which are take a little bit more of a common sense approach.
Yeah.
But now when you do something there, which we do internally as well, right? And it's tough when you're doing this by yourself, right? But you have somebody who sandbags your deal, right? Mm-hmm. And it's confirmation bias, but I'm on your side, Dane, where I'm out there, I'm looking for deals. I find the deal, and once you find the deal, knowing how hard it is to get somebody to take your offer and your terms, now you want to run with it, right? Because at that time, it's the greatest thing in the world, and you need those speed bumps along the way to say, well, what about this? What about that? About this? And we've taken approaches of like the 10th man, where you're going to argue every reason, find every hole. Like, here's my assumptions. Why doesn't this work? What about that? Well, what happened on this deal, right? It's not you're doing the same thing, right? Like you have somebody punching holes in everything you're saying, right?
Yeah. I mean, I think it's super healthy for deal junkies to do that, because otherwise we'd end up in deals that we don't want to end up in. And so I think that is the strength of having multiple partners, is we've all had something go wrong in a different way. And so we all see every deal through like a slightly different lens, even though we all want to do all the deals. We all see the deal through a different lens. It's like, oh, we got to watch out for XYZ on this one, or we got to watch out for, the loan isn't actually what you think it is on this one. Like, what's that term sheet from that guy? That's not, no, because it looks like it's saying it's this, but it's really going to be Dutch interest. You're going to be paying on the full loan amount for the whole time that you have a line of credit out, which on a project in Oregon where you're not kicking people out or raising rents, you might be, doing a construction project for years. Not like it's not, even if you're really good at construction, it's just it's a political restriction that makes it so you can't do it, right? It's a policy thing, not a you thing.
So what was the biggest, I don't say learning experience that you've gotten from one of your deals? You're like, wow, I'll never do that again.
Oh man. I've been pretty fortunate because I started with good partners. As far as learning experience that I would never do again goes, I would probably say getting really, really excited about assets that are outside of our buy box or getting excited about assets that are too large for us at a certain time. And so even though we probably could take down certain deals, we got under contract on a deal that was too big for us. And I couldn't end up closing it. And it took like 6 months, and we were going through a Fannie Mae loan. And I don't know if you've ever tried to do agency debt, but it is a nightmare to try to get it. The number of regulations that they have. We had, when we did like the inspections, we had 4 people fly out to the property, and one of the people's jobs was to carry a phone, like a Zoom phone around essentially. And there were 8 other people on the phone call that were all looking at the property and asking questions while we were walking through it. And so we just, I mean, I was not, it was so far out of my league, and I was the one that was trying to do the thing. And just like, it made it so that I ended up spinning my wheels on a deal that I like realistically knew was going to be super hard to close, and still spent 6 months on it. And then I wasted sellers' time too, and I wasted the broker's time. And I don't want to say wasted. We could have, there was X% chance we could have closed it. I don't know what it was, but it wasn't 100. And I think the biggest learning lesson for me, just as like somebody who wants to keep doing deals in my market and who's like more of a relational investor than like a transactional investor, is not wanting to sale fail, like not wanting to be the guy who can't complete a deal, because people remember that, right? Like I had to call that broker 2 days before Thanksgiving and be like, hey, it's dropping, right? And she was it was already a hard time for brokerage in 2022. No deals were really getting done, and that didn't make it any easier. I mean, that yeah, it was hard for her. I was not stoked about it. So really just like getting too big for my britches is probably the way to put it, where it's like you should very clearly know what your buy box is, know why that is your buy box, and know that you can execute on it, right? Like we probably have 10 deals right now that if we didn't have deals under contract, we would be under contract on them. But because we have deals under contract that we're raising capital for, sourcing loans for, running through escrow right now, and 150,000 into one of them just in due diligence and earnest money. Because of that, we're not under contract on those other deals, even though they're great deals, and we'll end up doing them hopefully in 6 months. But I've actually been kind of the brake pedal for the group to say like, hey, we shouldn't be doing 6 deals at the same time, because it's like you'd rather be doing 2 deals and close both of them than 2 deals and close both of them than 6 deals and close none of them. And it's super easy to get there. It's super easy to do 6 deals and not give them enough attention and not close them. So that's the long-winded lesson that I learned, I guess.
Or the deals and then not be able to operate them, right? And we've seen a lot of people do that. It's great to buy it, but then you own it, and you gotta operate it.
Yeah. I had a question for you guys. Yeah, why, when you look at a market that's out of state, because I was looking at some of the cities that your mobile home parks are in, what's your metric for other markets?
That's a great question. So we look for some sort of economic stability. So if you look at where we're located, most of them are either A, college towns, or B, defense orientated. So there's either military based, defense contractors that have proven businesses throughout time. And then we'll look at where there might be hubs. So if it's a manufacturing hub or an agricultural hub, where we know that there's some arteries that'll tie into that location, because we'll know there'll be a diverse economic region where it's not so dependent on one market itself. Those are 2 things we look for right off the bat, right? Before we select or we target a market to be in. And then as we've evolved, we'll also, because we're affordable housing providers, we look for a divergence in where the median sale price is to where our offering will be for a new home inside our community, right? So we'll typically, there's no hard and fast rule, but we like to be in markets where the median stick-built house is going to be over $150,000, because when we're selling a new home in one of our communities, typically it's between 60 and 70. So that's an affordable option if we have to do infill, where someone would rather live in in one of our communities. There'll be a delta between new home price and our price, and we know that we could infill faster, right, than what we might initially anticipate.
Yeah, no, that makes total sense. I didn't realize that. So where are you getting those homes from? Is that all the same manufacturer?
We have a couple of we have a couple of manufacturers that we work with. So we don't look at when we have homes to fill, right, or lots to fill, the home for us isn't a profit center, right? So if we're bringing in a home and we're setting the home, we might actually sell that home at a loss, right? Because for us, the home isn't really the profit center. It is, we know that when a resident is there and if they're paying a market lot rent, our ROI will be 33% or better within 36 months. Before we'll get back whatever that customer acquisition cost was, and now we've added an enterprise value to the community. So typically each lot that's filled adds about $40,000 to $45,000 to the price of the park. So we have to invest $10,000 to do that. We're more than it's a worthwhile trade-off each and every time, right? So
that makes sense.
And we underwrite our deals, and we'll break out the park-owned homes from the lot. So we do things that we think are a little bit different that works in our model that to make it work. As long as we can get it at the basis the lot basis that works for us. So we have a good. Yeah.
I was going to say, so what MSA are you targeting? Like population of the city that you're going to? Is there any minimum?
Again, I think you have to look at we typically obviously larger is better, right? So I think our biggest MSA is 200 to 4,000 people. Our smallest MSA will have over 50,000. So we're in that range, but we've done well in some smaller markets if we knew that there was a pull or a draw, right? So perfect example, Adel, Georgia, right? Which if you looked at Adel, Georgia, it's not a market that you would typically scream and say this is a market that does very well. However, when we bought Sunshine Acres, we bought it at a great basis, right? We had 85 lots for $1.2 million. We got 59 park-owned homes in that transaction, which needed work, and we knew that. But it's 30 minutes out of Valdosta, which has Moody's Air Force Base, and Adel, our park in Adel has half-acre lots. So we knew we could pull people in if we were marketing correctly to get them to, because we had something that other communities in Valdosta wouldn't have, which is a half-acre lot. Yeah. And so we're at, of the 85 lots, we've got 74 of those lots occupied. We're infilling the rest of those communities, and it's one of our best, had been one of our best performers in the portfolio from a value add creation and from a cash flow perspective. So, that's wow. And that's just us going down, the market. We have a great team down there.
Well, the team aspect of it, Dean, is also a big factor, right? So if we're in an area that we already have a team, right, obviously we like to concentrate in that area, right, because now we can just expand on the team that we have. So if we enter a market that does have a decent size MSA, but we find a park, close by that doesn't, right, but we can offset that by using our team to expand into that area. The team is key, right? How are you getting it to, the end of your plan? But, very key component is that having the team there.
So define the team for you guys for mobile home parks for me. What does that look like?
Every community is different, but typically, we're a value add. We buy value add opportunistic property. So, our park managers become kind of like half park manager, half project manager, right? So they invest in, following the plan and, bringing the homes in, overseeing small construction projects. But, we handle, dealing with the vendors with them on site. But park manager / project manager, groundskeeper, someone who does construction, whether it's a part-time person or a full-time person. We have a group of like 5 construction people that work throughout all of our communities. They've been traveling now for us. We have a handful of communities which are in close proximity, but if needed, they'll go far, and if we buy a park that's, maybe 2-3 hours away and we know we're going to need to do a considerable amount of work there, we'll earmark a home inside that community, clean it up, put furniture in that home, make it comfortable for them. They'll stay in that home, right? We'll put them in Airbnb for the first few weeks, clean up that home, get that home ready. Now moving forward, they have that home, and that home will stay there for them. If they're going to go out there for 2-3 weeks at a time, they have a place to stay. They're in the community. It's yearly work, and we build that team. We continue to build that team. If we bring on more people, we let them know, hey, we have local work, but we're most likely going to need you to travel here to there. And if they can travel, and they typically can, it works out well.
And we support our ground managers with a back end admin staff. So we have 11 people overseas that work with them in support. So our park manager doesn't have to get bogged down in paperwork, but they have back end support for them. And that's an office that we built out. We have a team overseas that will work in support of them. So they handle the marketing, they'll handle the admin, the data entry, so we can stay plugged into what's happening on the ground. While at the same time, our park managers can be the brand ambassador.
I mean, our park managers are always on the go, right?
Yeah.
Very difficult for them to be in an office doing paperwork and applications. They're showing the homes, they're going and looking at the projects, but having that back end staff, get the applications filled out, follow up with the potential new resident, follow up with the vendors, help them stay organized, is key.
Wow. So are your park managers, what's the like typical compensation? Like how are they being compensated for all that?
So they're paid employees, and we have bonus structures in place for them based on certain metrics, whether it's home sales or lease up, collections, unit turn, dates, days that it takes for the unit for unit to be turned. So we have a couple of KPIs that we track with them. If they hit it, we have bonus structures in place to allow them to be incentivized. As we do better, they should do better. So it keeps everybody's on the same page.
Yeah, that's huge. Yeah, and that was kind of what we were talking about too, with the asset manager versus the property manager, and just making sure that they totally understand what the business plan is. So that makes sense. Do they live for free at the park most of the time?
Some of them do.
Some of them do.
If you work for our company for more than a year and you live inside communities, one of the communities, we will give you free lot rent.
Oh, okay.
Right? So not all of our park managers live inside of our parks, though.
Correct.
Some of them are close by. But if you do happen to live in our community, or if you're an employee of the company and you've been with us for a year, that's a kind of bonus for being with our company.
Well, I'd say so, yeah. So do you find that the on-sites typically do a better job, or is it kind of random, just person by person, or?
Well, I think we've been very fortunate. I think because of our system, I think our on-sites are dedicated. They're on top of their game. I mean, so every on-site manager we have, a lot of them have been with us for a number of years, and that's helped grow in there. So I think we've got a good team in place right now. I mean, there's nobody that's managing a community that I'm saying, well, why do we have this person? So the reason why they're there is because they're doing an effective job, and we're just working with them to be the best that they can be, and obviously show them growth inside the organization.
Yeah, that's awesome. I wanna get back to a question that I skipped because I feel bad. I answered a different question and then didn't say. You asked if somebody was getting into it, and it's odd because a lot of times you forget what you would actually do, but I'm still on the newer end of things, and so I have a pretty good idea of what I would do if I did it again. And it wouldn't be like I think I got lucky in that I fell into it, but it would be pretty similar. And so to answer it in short is really just you need to find somebody if you want to buy your first deal, right? And you have no money, you're in this same position. You need to find somebody who will let you own part of the deal for doing a certain piece or multiple pieces of the deal for them. Money's one piece of the deal. Money's only ever one piece of the deal. And money, a lot of times on a good deal, is the easiest piece to find, frankly. It's harder to find a really, really good deal than it is to find the money for a really, really good deal. Because anytime you have a really, really good deal, everybody wants to give you money. But yeah, and so to that point, I would find that person though, so that then every conversation that you have is targeted at whatever that person wants, if that makes any sense. So just saying, like, I knew when I was going into a phone call exactly what I wanted from a financing perspective, exactly what I needed from a price perspective, exactly what I needed from the sellers on the term of the loan, on the interest rate on the loan for different properties, right? And I knew that broadly, if we could start that conversation, then I could get him on the phone and then it would end up working out. And so just knowing exactly what you want, specializing is the only way that you get a deal, right? Because there's 100 other people who are looking for that deal, and 50 of them are just as good as you, 10 of them are way better than you. And then one of them is the one who's getting most of the deals. And so being the jack of all trades in real estate just doesn't work, right? And that's why you at the start you want to be, because everything's so exciting and it's like, well, I could do this and I could do that and I could do, and it's like, yeah, you could do all of them, but you can really only do one of them.
Correct.
You can only do one of them well. And so that would be my take, is just finding someone you partner with and specializing.
I think we've got a lot here to take in, a lot that we've learned. So if you're starting out, you should get a partner, know their buy box so you know your buy box, right? So you can come, when you find a deal, have somebody that can sandbag that deal so you can push holes on it so you know what you're getting into, you know the pitfalls and the opportunities along the way. Know your market that you're in, because when you know your market, you can know where that deal has to be offered for it to make sense, right? And you can put it together from there. And I'd be remiss, because this is the MHP Exchange podcast, if I didn't ask you this one last question. Thoughts on the MHP space?
Thoughts on the MHP space?
Yeah.
Certainly on the coasts. Well, on the Oregon coast, I think there's a lot of deals still. I think there's a lot of deals. And part of the reason is because of what you're talking about, which is median home sale price versus the price of a park owned home or a tenant owned home. And just the barrier to entry there for what are actually really high quality houses, for the record. Like initially I had a really bad, which was skewed viewpoint of the quality of manufactured homes. And I don't have that anymore. I mean, I would certainly live in most of all of the new ones. They look great. They're in great condition. And that was kind of my biggest fear, is like, I didn't want to be a part of an asset class that I was felt kind of gross about. And I don't feel that way anymore after kind of diving into a couple deals that we looked at where it was like, oh, we could actually make a really sick community out of this. Like, people would really enjoy living here. And there's a huge value to that workforce housing that people need. I mean, every community needs it. And it sounds like that's kind of what you're talking, is the affordable housing, but then also just workforce housing. I mean, people need it. And on the coasts where we're so used to how expensive it is to live, just seeing the ability to give somebody a good place to live with no shared walls at a reasonable price is absurd. I mean, we don't have that in Oregon. And so that would be my take.
Perfect. Now, Dane, if somebody has questions, they want to find out or talk to you about deal structuring, they want to see what kind of deals you're doing, how would they get in touch with you?
My email is Dane@smire.com. And then I'm not going to give up my phone number on the podcast. But I assume you guys have the link to Deal Junkies. I'd love to blast that. We have a lot of fun on that podcast. You guys actually run this very similarly to the way that we run it, which is just loose and conversational. And I think that there's a need for structure, but I don't. A lot of podcasts are too structured and they get kind of dry. I'm not going to say which ones, but I think it's a pretty popular real estate podcast that I no longer listen to. So yeah, I'm a co-host of Deal Junkies. So listening to that and reaching out through there would be great. We have Instagram accounts and all the jazz to find us through there.
So learned a lot here.
Great call, Dane. Nice talking to you.
Great to have Dane on. A lot of information that we were able to wrap up here. If you were listening, you liked that show, give us share it on Spotify, iTunes, find us down there, give us a rating, send us your feedback at the MHPExchange.com. The MHP Exchange, your spot for opportunity, news, education, and entertainment in the mobile home park industry. If you have any questions, give us a call or reach out to Dane. Until next time, happy investing. Talk to you soon.